At the most basic level, business valuation is the process by which the economic worth of a company is determined. Business valuation can be useful in determining fair value of a business for multiple reasons, including sale value, establishing partnership, or taxation, etc. Business owners usually seek services of professional business evaluators for an objective estimate of the business value. There are a number of ways to measure business value. It is perceived differently by different people. A business owner, for instance, may define a business value by its contribution to the local community that it serves. An investor may weigh a business solely based on its ability to generate desired returns. Business value may also change with the change in market conditions. The value of a business is established by comparing a company to similar ones in the market that have recently sold. The competition for private businesses increases due to scarcity of jobs, as more people enter the business buying market in search on income, which drives up the business selling prices. 3 common business valuations are discussed below. Asset-based approaches. Under the asset-based approach, evaluators view a business as a set of assets and liabilities and total up all the investments in the company. Asset-based business valuations can be done in one of 2 ways. A going concern asset-based approach takes a look at the company's balance sheet, lists the business's total assets, and subtracts its total liabilities. This is also called book value. A liquidation asset-based approach determines the liquidation value, or the net cash that would be received if all assets were sold and liabilities paid off. Income approaches. The income valuation approach helps you to figure what kind of money the business is likely to bring as well as to assess the risk. The income valuation lets you calculate the business value in the present. To do so, the expected income and risk must be translated to today. There are 2 ways you can do this translation. Capitalization. Capitalization valuation method is the result of dividing the expected business earnings by the capitalization rate. The idea is that the business value is defined by business earnings and the capitalization rate is used to relate the two. For example, if the capitalization rate is 33%, then the business is worth about 3 times its annual earnings. An alternative is a capitalization factor that is used to multiply the income. Either way, the result is what the business value is today. The capitalization method works great for businesses with steady, predictable earnings. Discounted cash flow. This method is based on projections of future cash flows, which are adjusted to get the current market value of the company. The evaluator figures out the discount rate which captures the risk of getting this income on time and in full measure. Market value approach. Market value approach value a business by comparing the company to similar ones that have recently sold. The market is a competitive place, so the economic principle of competition applies. This method only works well if there are a sufficient number of similar businesses to compare. Evaluating a sole proprietorship based on market value is particularly difficult, as they are individually owned, and there is no or very less public information available on prior sales of the similar businesses. The market approach involves finding a price multiple of the benchmark, i.e. price to earnings ratio, EV, enterprise value, to EBITDA, earnings before interest, taxes, depreciation, and amortization, price to book value, etc. The price multiple is then multiplied with the relevant financial metric of the business, being valued to arrive at a valuation estimate.